How's it going all? Welcome back to the channel. So in this video, we will be talking about how you can earn up to 5% interest on your cash guaranteed while still keeping your money FDIC insured and fully protected. Best of all, these rates will almost always be higher than what you would get at some of the best high-yield CD accounts at popular banks like Ally Bank and Capital One. And finally, at the end of this video, you might be convinced to never touch bank CDs ever again. So without further ado, let's get started. When we talk about savings, most people immediately think of a traditional high-yield savings account, something very simple and something as easy as Capital One's 360 Performance Savings, which earns you 3% interest stress-free. No minimums, no fees, just a very simple way to park your cash and earn a decent interest rate. Of course, a high-yield savings account is probably the best option for any cash that you might need to use in the next few months. Now, if you plan on holding your cash for at least a year, most people start thinking about bank CDs as their best option. And for those of you who haven't used a CD or certificate of deposit before, this is a type of savings account where you lock up your money for a given duration, often between 6 months and 5 years. Why would you do this? Well, in most cases, you can secure yourself a higher interest rate for the entire duration and earn more on your savings. For example, at Capital One, you can earn 4% interest if you lock up your money for 1 year. That's a full percentage point higher than going with their traditional high-yield savings account. And honestly, that's pretty nice. Say that you're looking to buy a house years down the road, you could even take advantage of 2 and 5-year CDs, which are paying just a little bit more. And the best thing about CDs is that you secure that interest rate for the entire duration. The money in your CD will always earn 4% each year, even if interest rates begin to fall. You are fully protected and will still have that dependable passive income. Bank CDs are great and they will continue to be a wonderful option to earn higher interest rates on your savings. That being said, there's arguably a much better option, and that is with brokered CDs. These are CDs issued by banks like Capital One that you can buy on the secondary market. Popular brokerage firms like Vanguard, Fidelity, Charles Schwab, and Merrill Edge all offer you CDs from hundreds of different banks across the country. And because brokered CDs are still debt obligations of the issuing banks, the money you deposit is still FDIC protected. And the nice thing about brokered CDs is that they work the exact same way as bank CDs. If you hold them until maturity date, you will be paid all of your money back plus interest. However, because brokered CDs are tradable on the secondary market, you can also sell them before it matures. The value of your brokered CD will fluctuate though, depending on many factors, including the size of your deposit, the interest rate environment, and the time until maturity date. This feature is unique to brokered CDs and makes them very liquid relative to bank CDs. Now, if you find yourself in a pinch where you need cash immediately and your CD has not matured yet, you could sell your CD early through your brokerage account. And depending on those previously mentioned variables, you might even potentially realize a profit by selling your CD early. And that's not possible at all with a bank CD, where you're almost guaranteed to be penalized, often by losing 3 to 6 months worth of interest if you cancel your CD early. I should mention though that some brokerages do charge a small fee if you sell a CD before maturity date, typically about $1 fee for every $1,000 CD. So definitely keep that in mind. So now that we understand the basics of brokered CDs, let's discuss why these can be much better than bank CDs. And the first advantage is higher interest rates. On Capital One's website, they're offering 4% interest for a 1-year CD. That's not bad. However, if I pull up Charles Schwab instead, I have a wide selection of FDIC insured banks offering 4.8% interest for the exact same duration. It's almost a full percentage point higher than going with Capital One. And if I want to lock up my money for 2 years or more, I can secure myself almost a 5% interest rate for the entire duration. And to put that in perspective, these brokered CDs are offering about $100 more of interest for every $10,000 that you deposit. And for most people, that's a pretty significant improvement. And overall, you can earn much more interest through brokered CDs than with bank CDs. Now, a common question that I get asked is, why are yields higher on brokered CDs compared to bank CDs? And the answer is that brokered products are in a much more competitive market. A broker like Fidelity or Charles Schwab can transact large volumes of capital and deposits, allowing them to negotiate much more competitive rates with banks for their customers like us. The second main advantage is the ability to expand your FDIC coverage beyond that traditional $250,000 per account owner. You can combine a number of CDs issued by different banks through the same brokerage account. For example, I could put $250,000 into broker CDs each at Ally Bank and Capital One. I'd still end up with $500 of FDIC coverage even if I'm managing all of my money on Charles Schwab. One really important thing to note is that your FDIC coverage counts all deposits and brokered products with a bank. So if I have $100,000 at Ally Bank in their regular high-yield savings account, I can only deposit up to $150,000 inside of their brokered CDs. I can't put more than $250,000 of cash inside a single bank, regardless of what type of CD I buy, whether it is a bank CD or a brokered CD. And finally, the third main advantage is variety and convenience. For example, on Charles Schwab, I can buy 1-month CDs offering 3.4%, which is 40 basis points higher than Capital One's 360 performance savings. I'd still get that same level of liquidity, but with a small boost on my interest rate. Additionally, if I want a more hands-off approach, I can also automate my savings through making a CD ladder. This allows me to earn some of the highest interest rates possible while still allowing my money to be relatively accessible. So now that we understand the advantages of brokered CDs, how do we go about buying them? Again, you can buy them with any brokerage firm, but I will use Charles Schwab because I personally like their platform the most. However, the steps are practically identical to Fidelity, Vanguard, and Merrill Edge. They just have slightly different user interfaces. So at the very top, you can hover over Research, select Bonds, CDs, and Fixed Income Assets. On this page, you'll see all of the best rates possible on their fixed income offerings. And right now, CDs are paying some incredible rates for many different durations. And what's particularly nice about Schwab is that all of the CDs they offer come from FDIC insured banks, so there's no risk of me losing protection here. Definitely check with your brokerage though to see if that's true. But popular firms like Vanguard and Fidelity only partner with FDIC insured banks. Keep in mind that you can also buy US Treasuries like T-bills, notes, and bonds through your brokerage account. And I personally like it a lot because you can get slightly higher yields while dealing with a much more usable interface compared to Treasury Direct. But that's a topic for another video. Regardless, these T-bills and T-notes and T-bonds are very good options because the interest you earn is exempt from state and local income taxes. So if you live in a high income tax state like California, these are definitely worth looking into since those tax savings might make up for the small difference in yields between CDs and Treasuries. Anywho, you can select the duration that you would like to lock up your money for. I'll just go with a 1-year CD for the sake of this video. Here, you can see that there are a plethora of options, including popular names like Morgan Stanley, Ally Bank, PNC Bank, and many more. Now, there's a lot of information on this page, and it can look very intimidating. However, what are some important factors for us to consider? The first is the coupon and the coupon frequency. A coupon is the annual interest rate paid on a CD. Some of these will start paying you interest semi-annually, while others will pay you all at once on maturity date. And the second factor is maturity date, and you should pick out which ones work best for you. Some of these expire in November 2023, while others have a few more months left in them at February 2024. The third main factor is whether your CD has call risk. A callable CD is one where the bank has the right to liquidate your CD before maturity date. These brokered products pay a higher interest rate, but carry more risk because you might not be able to hold on to it until maturity date. So for example, say that you bought a callable CD from Ally Bank paying 4.7% APY. If interest rates do fall to say 1% next month, Ally Bank probably doesn't want to continue paying you 4.7%. Instead, they might liquidate your CD early and offer you a much lower interest rate instead. Rest assured, you will still be paid all of your principal back plus any accrued interest. However, you won't be earning 4.7% APY on your cash anymore. So to avoid that call risk, many individual investors buy non-callable CDs. These are CDs that are issued by banks that they can't liquidate early. So if you buy a non-callable CD at PNC Bank offering that same 4.7% APY, you are guaranteed to continue receiving that interest income even if rates begin to fall. The fourth factor is purchase price. CDs can be sold at a discount from their face value. For example, the Ally Bank Brokerage CD has a purchase price of 98.3, which slowly rises to 100 as you approach maturity date. In other words, I can deposit $98,300 into their callable CD, earning 3.25% APY from their coupon payments. When the CD matures, I'll be paid $100,000 while still pocketing my 3.25% interest. So if you factor that $1,700 of capital appreciation plus the interest payments, your total return is labeled APY or YTM, which is 4.685% for this Ally Bank CD. Other CDs might have a purchase price of $100. So if I deposit $100,000 into a KeyBank CD, I will be paid back $100,000 on maturity date, so no capital appreciation here. However, I would receive a higher coupon payment of 4.8%. So if you're interested in maximizing your return on investment, you might want to prioritize APY or YTM, otherwise known as yield to maturity. And if you're only interested in receiving interest payments as a source of income, you might prioritize coupons instead, since these are guaranteed payments that you can rely on. And the final two factors to consider are min and max. Min refers to the minimum amount that you need to purchase in order to get those advertised APY rates. CDs are generally sold in $1,000 increments, so a min of 1 means that the minimum to deposit is $1,000. A min of 25, like Ally Bank in this case, means that you would have to deposit $25,000 just to get those advertised rates. And personally, I like Schwab a lot because there are many banks offering great rates with low minimums. And the max number is not super important because most people will only buy up to $250,000 to still have that FDIC insurance. So as an example, I can select the KeyBank CD description to learn more about their details. This is offering 4.8% coupon payments, but with a price of $100, so no price appreciation expected. I can then find the CUSIP number and the FDIC number to ensure that these securities are registered and come from FDIC insured banks. You can also see a summary of their expected yields and their coupon frequencies. So in our case, it's semi-annually, so I should expect interest payments to my brokerage account every 6 months. And down below, you can check to see if this CD is callable or not. In this case, it is a non-callable CD, so the bank cannot liquidate my CD early before maturity date. Of course, if that all looks good to you, you can select buy. Personally, I'll just put down $1,000 and check that the yields are as expected. You can automatically roll over your CD by allowing Schwab to reinvest the CD on your behalf in the next available one. Personally though, I like to manage my own investments, so I'll select no. Finally, you can then verify and submit. I'm all set to earn 4.8% interest on my uninvested cash. As you can see, brokered CDs can be a wonderful option to earn much higher rates while also offering you more flexibility and convenience. Best of all, your money is still fully protected by FDIC insurance while still giving you more income than with bank CDs. I know it's a little bit complex and a little bit complicated to learn. However, I hope this video was worth your time so you can save more money. Either way, I'd love to know your thoughts and whether you think that brokered CDs might actually take the cake over bank CDs. As always, if you enjoyed this type of content, feel free to leave a like, subscribe, and I'll see you next time. Have a good one. Bye-bye.